Hello everyone, it's Marshall Gittler on behalf of Claws and Horns. I'm going to discuss the main issues facing the FX market in the coming week beginning 7th of August. The theme for the week is low volatility. We're entering the summer doldrums. Looking at the data for the last 9 years, the week beginning August 7th is, on average, the least volatile week of the year. So, if you're a trader looking to take off a week for a summer holiday, this coming one might be a good choice. I think the slow market is probably a result of two factors coinciding. One is, a lot of people probably do take this time off. And secondly, even for those people who stay by their screens, there isn't a whole lot of news coming out this week. So, what might cause some volatility this week? The main thing I'd be looking out for is news out of Washington. Things there seem to be moving at an accelerating pace. With regards to the investigation into Russia's possible interference in last year's election, a grand jury has been impaneled and the subpoenas have apparently started flying. That means they're carrying out a criminal investigation, not just a counterintelligence probe. Now, it doesn't mean that they'll find anything. They don't need to have evidence that a crime took place in order to look. But nonetheless, it is an escalation of the investigation, and that's bound to upset some people in high places in Washington. As the graph shows, policy uncertainty is a vague but noticeable driver of eurodollar. I've shown this graph before. It's based on an index of policy uncertainty derived from the media and other sources. The green line shows U.S. policy uncertainty relative to European policy uncertainty. When U.S. policy uncertainty is rising relative to European policy uncertainty, eurodollar tends to rise too. And that's clearly what's happening now. Other than that, the main U.S. economic indicator out during the week will be the Consumer Price Index, the CPI, on Friday. The annual rate of change of the headline CPI is forecast to accelerate by 0.1 percentage point, while the core index is expected to remain at 1.7% year on year. Now, this isn't actually the indicator that the Fed uses to gauge inflation, but it is closely watched by the market, since it's the more widely accepted version of what constitutes inflation. Even a slight rise in the headline figure could help to support the dollar, in my view, as it would allow the FOMC members to continue to hope that inflation will indeed return to their target level over the medium term. The U.S. Producer Price Index, the PPI, is also coming out during the week on Thursday. That too is expected to rise. Now, the combination of the two, some acceleration in consumer prices and producer prices, may give some support for the dollar. Now, speaking of CPI and PPI, China announces its CPI and PPI on Wednesday. The rate of growth in the CPI is expected to remain unchanged, but the PPI is expected to nudge upward slightly. That could be significant because the rate of growth in PPI actually, as you can see, slowed for the previous 3 months. The reason that Chinese PPI is so important is because there's a close correlation between China's PPI, which is the wholesale price of Chinese goods, and the U.S. import price index. This is another factor in favor of higher inflation in the U.S. Of course, China exports to a lot of countries, so the impact isn't just U.S. specific. Nonetheless, I'd estimate that it's greater for the U.S. than for most other G10 countries, and therefore a higher Chinese PPI might be helpful for the dollar. There's only one central bank meeting this week, and that's the Reserve Bank of New Zealand, the RBNZ. I'd guess that nobody in their right mind expects any change in the RBNZ's official cash rate, or OCR, since that's basically what the RBNZ members themselves have been saying for some time. Now, before the last RBNZ meeting, the market saw a 50-50 chance that there could be a rate hike by next March. That's the purple line here. as you can see, market participants have been gradually pushing that forecast out. Now the estimate is sometime around May or June. Still, that might not be pushing it enough, in my view. The RBNZ has said it's going to keep the OCR, quote, on hold for the foreseeable future, unquote. And moreover, and this is significant, it said it's equally likely that the next move in the OCR could be down as well as up. Now, that's significant because, as it stands now, the market sees absolutely zero chance of a rate cut. I can't even draw you a graph of it because it is zero for every month that we have data for out to the last meeting in 2018, next year. But the data from New Zealand recently haven't been that great. Some of them have been fairly soft. Inflation has slowed, that's the green line in this graph. The rise in house prices has slowed, the purple line, and sales have plunged. And overall GDP growth slowed in the first quarter. We don't have the second quarter data yet. At the same time, the New Zealand dollar is up about 2% against the US dollar since the last RBNZ meeting. Although, admittedly, the trade-weighted index is about unchanged. Personally, I don't expect any change in the RBNZ's view and very little in the statement. But if there is a change, I'd expect them to go along the same way that their neighbors in Australia did and take a slightly more dovish tack. There could even be some comments on the exchange rate, although I think that would be a bit disingenuous. The Kiwi has appreciated against the Australian dollar, even while it's rising against the US dollar. And Australia is the country's major trading partner. In any event, I would expect the surprise, if any, to be on the downside and for the New Zealand dollar to weaken as a result. The beleaguered British pound may get some relief on Thursday when the output figures and trade data will be released. Both industrial production and manufacturing production are forecast to rebound slightly. That would be a relief because although the soft data, such as purchasing managers' indices, suggest that the weaker pound has been helping manufacturing, so far it hasn't been showing through in the hard data. The trade data, too, is forecast to corroborate this idea. The visible trade deficit is forecast to narrow notably, showing that perhaps finally Britain's getting some benefit from the weaker pound. As for the other major indicators out during the week, for the Eurozone, the key indicator during the week will be German industrial production on Monday and the trade data on Tuesday. Looking at the consensus forecast, they've got mixed implications for the euro. Industrial production is forecast to slow, but the trade surplus, which is now a politically sensitive issue, is forecast to rise. It's difficult to say what the net effect would be. I think the market's in a mood to buy euros right now, so I think investors might forgive the slowdown in output and focus on yet another increase in the country's trade surplus, which is a red flag for the Trump administration. Japan has a few worthwhile indicators out this week, including the current account data on Tuesday morning, Japan time, and machinery orders and PPI Thursday morning. The current account surplus is forecast to rise, and the rise in the PPI is forecast to accelerate. Both of these indicators would tend to be positive for the yen. And that's about it for my outlook for the week. This is Marshall Gittler for Claws and Horns, bringing you the outlook for the week beginning 7th of August. Good luck in your trading.